Structuring, or smurfing. This is the classic trick of breaking big piles of cash into lots of little pieces. Instead of walking into a bank with a bag of cash that screams suspicion, launderers send in smurfs, people making smaller deposits across many branches or ATMs. Each deposit looks ordinary, but together they move huge amounts under the radar. It doesn't stop at banks. Prepaid debit cards, mobile wallets, or money orders work the same way. Load 100 cards with small amounts, move the money around, then cash it out somewhere else. By the time it's pulled back together, the original dirty cash has slipped into the system quietly. The final touch is paperwork to make all those tiny deposits look natural. A corner store might claim higher daily sales, or a nail salon might record extra customers. On paper, the numbers explain the money, even though the customers never existed. Trade-based money laundering. This method hides dirty money in the enormous flow of global trade. The trick is simple: lie about what's being shipped, how much of it, or what it's worth. Take over invoicing. A seller charges way more than an item is worth. The buyer wires the inflated payment, and now extra money has traveled across borders disguised as trade. Under invoicing flips it. Goods are sold on paper for a fraction of their real value, then resold later at full price. Both tricks move value while keeping the paperwork neat. Some launderers don't even bother with real goods. They create phantom shipments with forged bills of lading, so money flows internationally for products that never existed. With millions of containers moving every day, slipping in false records isn't as hard as it sounds. Shell companies and front businesses. A shell company is just a legal shell, an entity with no real operations, set up in jurisdictions where owners can stay hidden. These shells shuffle money between accounts, issuing fake invoices for consulting or licensing fees. To outsiders, it looks like business as usual. Front businesses actually operate but exaggerate their income. Think bars, restaurants, or car washes where cash turnover is hard to verify. If a pizza shop claims it sold 800 pies when only 200 were made, the extra money can be banked as WAC as revenue. Often, shells and fronts work together. A front records fake sales, then sends money to a shell overseas as payment for services. The shell, in turn, moves it into other accounts or investments, each layer pushing the dirty cash further from its source. Real estate. Property has always been attractive to launderers. It's expensive, it usually appreciates, and it creates long trails of paperwork that seem legitimate. Dirty cash buys an apartment, then a few years later it's sold. The profit looks like normal property appreciation. Sometimes the price is the trick. A building might sell far above market value, so the seller can receive more money than the property is really worth. Or it sells way under value, with the rest exchanged under the table. Either way, value moves while hiding its true origin. In cities like London, New York, or Dubai, luxury apartments often sit empty, owned by offshore companies or trusts. For investigators, tracing who really controls the property can be almost impossible. Professional gatekeepers, lawyers, accountants, and company formation agents can act as shields. They may not always know the money is dirty, but their services, setting up trusts, creating companies, or moving funds through escrow accounts, give laundering an air of legitimacy. If a transfer comes through a respected law firm, it looks far less suspicious than if two anonymous companies wire money to each other. This layer of respectability slows down scrutiny and buys time for the launderer. Cash-intensive businesses. Some businesses naturally deal with piles of cash, making them perfect laundering covers. Casinos are a classic example. Buy chips with dirty cash, play a little, then cash out with a check or bank transfer labeled as winnings. Restaurants or corner shops do a simpler version. They inflate their daily sales numbers. If a store actually made $2,000, it might report $5,000. Deposit the extra $3,000. And the bank sees it as business revenue. Money service businesses and informal networks. Money transfer services and informal systems like hawala move value outside the normal banking rails. In hawala, money doesn't even travel physically. A broker takes cash in one country, and another broker pays it out in another. Later, the two settle up with goods, bank transfers, or cash. These systems thrive because they're trusted, fast, and lightly documented. Criminals use them for the same reasons migrant workers do. They work when banks are slow, expensive, or unavailable. Cryptocurrency. Digital currencies opened new doors for laundering. Criminals can swap cash for Bitcoin or other tokens at exchanges or even crypto ATMs, then send it across the world in minutes. To break the chain of transactions, they use mixers that shuffle coins between many wallets, or privacy coins like Monero that hide addresses altogether. Some push the funds through decentralized finance platforms, swapping tokens, staking them, or lending them out. so the money now looks like legitimate crypto trading. NFTs add another wrinkle. Someone can mint a piece of digital art, sell it to themselves through different wallets at a crazy price, and then claim the payout as legitimate art income. On the blockchain, it all looks like a real sale. Offshore havens. Tax havens and secrecy jurisdictions still play a major role. By routing money through banks and places that protect account holders, launderers bury the trail. Trusts, foundations, and layered companies stretch across borders, making it difficult to pin down who controls the funds. The strategy is to move money through several countries, each with its own legal shield. A Caribbean shell pays a European trust, which then invests through an Asian holding company. By the time investigators try to follow the trail, it's obscured by different laws and secrecy rules. Loanback schemes. In this trick, dirty money is disguised as a loan. The launderer parks funds in a foreign account, then arranges for that account or a company they secretly control to lend the money back to their business at home. Now, the business repays the loan over time, with interest. On paper, the income looks like legitimate investment returns. In reality, the launderer has just paid themselves back with their own money, now dressed up as clean capital. Cash smuggling. For all the clever financial tricks, old-fashioned smuggling still works. Cash is stuffed into suitcases, cars, or hidden in shipping containers. Once it crosses a border, it can be deposited, exchanged, or spent with less scrutiny. Criminal groups often combine this with other methods. Smuggled cash might be turned into gold, wired through a cooperative bank, or converted into cryptocurrency. The appeal is simple. No paperwork, just physical movement of value. Commodities as value stores. Gold is one of the most popular. Buy gold with dirty cash, melt it down, ship it overseas, and sell it again. The value has changed form, but not amount, and the resale creates a clean paper trail. Diamonds and other gemstones serve the same role. Portable, valuable, and easy to conceal, they cross borders with far less oversight than large bank wires. In some regions, timber, oil, or agricultural goods act as the same kind of informal value store.